needs to guard against. My name is Michelle Maranaka, and I'll be your moderator for this morning's webinar. Before we get started, just a quick note about your webinar pane. We are using GoToWebinar, so just make sure to pull the arrow if you all of a sudden do not see the webinar pane in front of you. And also feel free to submit any questions that you have for our staff throughout the duration of the webinar. We will try to get to those questions at the end. We also want to make sure that you have the correct audio settings set. So if you are calling in using your telephone, please make sure that you select telephone. If you are using your computer, please select mic and speakers. For those of you that hope to have CE credit, there's a couple of rules that you must follow. You must use a personal computer and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. We ask that you actively respond to at least 75% of the polling questions, and please do complete the evaluation survey at the end of the webinar. And with that, I'd like to introduce our presenters for this morning. First is Jeff Stegner. Jeff has the CPA, ABV, and CFE designation. Jeff has nearly 25 years of experience in public accounting, the last 15 of which have been focused in valuation and litigation support services. Jeff has investigated dozens of frauds and assisted not only in the investigation, but the reporting and prosecution as well.
Good morning.
Our second presenter is Paul O'Grady, and Paul is an audit partner here at Armanino. He heads up the nonprofit practice and has more than 18 years of experience serving nonprofit organizations. Welcome, Jeff, and welcome, Paul.
Thank you. Thank you very much.
All right, and I'll turn it over to Paul, and he's going to walk us through our learning objectives.
Good morning, everybody, and welcome to our fraud presentation. Today we're going to be covering a couple of learning objectives, one of which is the results of the most recent report to the nation on fraud, which is put out by the Association of Certified Fraud Examiners every year and has been published every other year since 1996. The report captures fraud statistics via insurance, court, and police records, compiles these results, and includes them also with submissions by certified fraud examiners to the association. The results are always interesting and sometimes a little scary. We're also going to cover the most common types of frauds perpetrated on both for-profit and non-profit entities. And then finally, we'll go over what are, in our opinion, some pretty simple techniques that organizations should consider and implement to reduce the risk of fraud occurring at their organization. What one always wants to get to a point of is avoiding detecting fraud after it's too late. So hopefully some of those techniques that Jeff and I will talk about will help your organizations to put processes in place to detect fraud. Finally, Jeff, who is a certified fraud examiner, as you know, and who handles a lot of fraud investigations throughout the year, is going to share some actual case studies with us throughout the presentation, which are always very, very interesting for all of us to hear.
Good morning. As Paul mentioned, there's a few things we're going to be covering here. The first thing is the types of fraud. I'm going to define each type of fraud that is covered in the report to nations. I also always talk about the fraud triangle, how fraud is perpetrated. We're going to summarize the findings in the 2014 report. We'll talk about the methods of how, in the report, they talk about the various statistics on how fraud is detected, the types of businesses that are most often hit with these types of fraud, as well as the losses that are associated with those frauds. We're going to cover a number of the red flags employees show before committing such frauds, or employees or executives, really. And then we're going to talk about the types of techniques that can help companies to prevent fraud in the future. We got a little bit of a checklist at the end. Just a couple statistics we're going to share here. I think there's about 1,500 cases that are included in this survey that are reported. and it's been put together since 1996. I don't think we have a case in there this year, but it's my goal to have one in there next year for sure. The fraud techniques that we're going to talk about, some of them are very complex, some of them are very simple, some of them are, I'm sure people will be sitting on the phone saying, oh, wait, we don't do that. So hopefully this will be enlightening and can benefit everyone here on the line. First is a definition of occupational fraud, which is the use of one's occupation for personal enrichment through the deliberate misuse or misapplication of the employing organization's resource or assets. So any type of fraud, where you're taking cash from a company, where you're taking office supplies, that becomes occupational fraud. You're converting business or organization assets into your own personal benefit, outside of compensation for work performed. And it also uncovers inflating company share price to possibly benefit a few of the upper level employees in an organization. What we as CPAs are good at is determining a cost benefit. You don't want to spend $50,000 investigating office supply theft, where you would want to spend that trying to prevent, as you'll see, the financial statement frauds average about $1 million. So those are ones you definitely want to protect against. I've got the cover here of the report. If anybody wants a copy of the report, please let us know. Our emails are at the end of this webinar. We'll be happy to send it to you. You can also log on to the ACFE website and download your own copy. Just a couple of scary statistics here. Once again, the estimated total loss to fraud for a typical company is 5% of revenues. That's top line. But think about that for a second. On a global scale, that's $3.7 trillion could be lost to fraud on an annual basis, is what they're estimating. The average fraud lasts about 18 months before it's detected. 58% of all fraud losses have no financial recovery. Once that money's gone, it's gone. The median loss for reported fraud is $145,000. 22% of the losses in this survey topped $1 million. So this is a fraud triangle. I put this up on every single one of my presentations related to fraud. There's three sides. Fraud cannot exist without all three of these being present. Pressure, somebody has a financial need or is experiencing some financial difficulty. Rationalization, I'll go down to the bottom here. Rationalization, why they are justified in committing this fraud. And the one that everyone on the line here, as well as Paul and I, can control the best is opportunity. If the opportunity doesn't exist, just like any triangle, if one side doesn't exist, the whole thing falls apart. But the only thing we can control here is opportunity, not allowing an opportunity for these types of frauds to exist. The putting in place financial controls, making sure those financial controls are being followed and not being overridden. As well as there's some other things we'll talk about here, some other techniques that can be put in place that are very simple that can prevent, that can help this fraud triangle collapse and prevent frauds in the future. So the three types of fraud that we'll talk about here are fraudulent financial reporting, which is basically the financial results of a company are reported a different amount than is correct in order to benefit a select few of the employees. You got to think Bernie Madoff, Enron, where financial statements of companies are inflated to benefit the shareholders or a few of the shareholders, employees that hold the most shares. Asset misappropriation, just flat out stealing, by far the most common type of fraud that occurs. And corruption, where employees use their influence to conduct transactions that benefit themselves, that violates their duties at the organization. Basically, when they're working together to benefit themselves, this takes, obviously, collusion. This type of fraud is more common outside the United States than inside the United States, but is one of the leading types of fraud out there. So asset misappropriation. We have a graphic on on a few here. As I said, 85% of all cases reported in this report to nations were related to asset misappropriation, extremely common. It also had the lowest median loss of all three categories at about $130,000 per occurrence. That's up a little bit from the last survey by about 10 grand. The main reason this is so common and the loss is relatively low is that these types of frauds usually relate to one person. So they have a lack of oversight. They don't have to work with anybody. You don't have to worry about anybody turning anybody else in. It's one person that isn't being checked often enough. So I've listed the most common types here in a little matrix. I'll kind of explain a few, and I've got some stories related to some of these. So skimming is an off-the-books type of fraud where cash usually it never gets reported anywhere. The most common type of skim comes for goods or services paid for in cash. About 20 years ago, I invested in a parking lot operation where people would come park at sporting events, and everything was paid for in cash. I believe they hired a helicopter. I think it was a major sports facility here in the Bay Area. And the investigating unit hired a helicopter to count the number of cars that were in attendance and try to match it up with the collections that they had. Restaurants, bars and restaurants are notorious for losing money to skimming because it's all reported in cash. The number one rule of stealing cash is to spend it immediately. That's why you get almost no financial recovery. One nonprofit I investigated in this area probably 10, 15 years ago was a soccer association where there was one family that controlled all the parking fee collections for the events where they charged whatever it was, $5 for parking, I guess, at some soccer tournaments. And one family offered to help out with that and took over basically all the operations. And they collected the fees and paid their referees in cash. Whenever there's cash floating around, I get very, very nervous. It's too hard to track that. Cash larceny is when you're actually stealing cash, so it's an on-the-book scheme. Cash comes in and then just disappears. The best example I have that for a nonprofit organization was a school, I believe, that was getting a credit from the county for some of the work they were doing. They get a credit every couple of years for like 60 grand, and the money came in, it was on the books and then expensed somehow, but the controller was just taking the money and nobody ever was checking where she was depositing the money. She ended up putting the money into an account that she set up in her name and the company name, and it came up because the IRS sent a notice saying, why didn't you report the interest on this account? So that's how it came up. Billing loss, this is another very common one that it's very simple to perpetrate a large loss in this area where basically the false bills are generated or fictitious vendors are being paid by the company. I think it's 22% of all cases in this survey, which is down a little bit. It was 25% in the last study. But basically a fictitious vendor is created and then invoices are submitted and paid. The scary thing about this is how easy it is to set up a fictitious vendor by QuickBooks now. Expense reimbursement is where people are fraudulently paid for expenses they did not incur. I had one private school I investigated where the principal, I believe it was simply just taking cash, saying she was using it for school expenses, but never submitted any expense reports. So obviously our recommendation, you can only pay for original receipts. But in general, I investigate frauds both in for-profit and not-for-profit. And in not-for-profit organizations, the controls are much more lax than they are in for-profit organizations. And these things can happen. You're trying to do benefit for the greater good. Everybody should be focused on helping the community. But unfortunately, that creates opportunities such as this. Check tampering, another one I can highlight here, where people are manipulating checks. The biggest one I investigated last year was an organization that the payables clerk was altering checks after they'd been input in the system, which is a big system that had some controls in place, big accounting system. It's a for-profit organization. But he said that he would alter the checks as soon as they were printed, and then change it back in the system when it came out. the account that he was using was one that wasn't very well maintained, the one that he was, I believe, maintaining the reconciliation for. What's worse, he said they had to work off hours because he couldn't come in before 10, but he would stay till 8 every day. And by that way, he would have 2 or 3 hours in the business by himself, where he would go to the unlocked drawer where they kept the check stamp and take the stamp and stamp the signature, the authorized signature on the check. Talk about opportunity. A couple more that are on here. Payroll are usually ghost employees, fictitious employees that are put into the system. The last one I was going to talk about is another nonprofit. I did this last year. It was a homeowners association where a vendor was maintaining the books for the association, and a longtime employee, more than 10 years, we'll talk about this in a minute, had too much control, not enough oversight, and was taking money in unauthorized expense reimbursements from the homeowners association to pay her Home Depot bill and her credit card bills. That went on for a number of years before it was finally caught by the vendor, actually caught it and fired her. But the other scary part of it is, as I understand it, she was employed in the same industry within months of being fired for fraud. We have a polling question coming up here.
All right, we do. We have our first polling question. In just a second, you're going to see it on your screen. And just a reminder for those of you that are hoping to get CE credit, we do ask that you respond to at least 75% of these questions. So the question reads, which of these is not part of the fraud triangle? Is it rationalization, opportunity, trust, or pressure? Let's go ahead and make your selection. Give you a couple more seconds to respond. All right, now it looks like we have just over 80% that responded. So thank you very much. We're going to go ahead and close the poll and take a look at the results.
So close. Well, I thought we had 100% on this one, but the correct answer is C. Trust is not part of the fraud triangle. One of my, I believe it was my audit professor in college said, people you don't trust can't steal from you. It's the people that you do trust. Nobody you wouldn't put anybody in control of anything if you didn't trust them, obviously. But trust is not part of the fraud triangle. Rationalization, opportunity, and pressure. And the one that we can all control here is opportunity.
You know, it always scares me when I listen to Jeff go through some of the examples, and particularly when he has, multiple new examples every year, which tells us that, fraud is going on out there, and we need to be certainly aware of it. I suppose the good news to some degree is that a lot of the schemes that Jeff referred to, there are certainly some processes that we can put in place and that we'll talk about a little bit later that can certainly help us in reducing the risk of those types of frauds occurring at our organization. I'm going to talk a little bit about the study and some of the findings of the study with respect to the various types of fraud. Corruption, according to the study, is present in 36% of all cases. And the average loss to corruption in the survey actually was over $200,000. This is actually a study that indicates that corruption is probably more of a problem worldwide, or should I say outside of the United States, than it is in the United States. That's not to say it's not present here, but certainly in some of the less developed countries that have differing ways of doing business, so as to speak, corruption tends to be a lot more prevalent. The next type of fraud, which is financial statement fraud, is the least common, but unfortunately the leverage involved in financial statement fraud and misrepresenting financial statements tends to significantly increase the losses. So if we go back a number of years and we think of some of the big financial statement frauds, both in the nonprofit and for-profit sector, but certainly some of the ones that come to mind in the for-profit sector were Enron and WorldCom. The losses tend to be catastrophic in many cases with financial statement fraud. So while only 9% of the cases reported involved financial statement fraud, the median loss in those types of frauds was approximately $1 million. What is interesting is that since we started looking at these surveys back in the late 90s and early 2000s, the median loss is down somewhat significantly over the last number of years in the arena of financial statement fraud. And in fact, since 2010, which is 4 years or so, the median is down over $3 million, median being 4.1 million in 2010. Why that is, we're not sure. Jeff here, one of my colleagues, he has some thoughts, one of which is it potentially is related to Sarbanes-Oxley and the requirements of Sarbanes-Oxley to have very, very robust controls, to have those controls tested, and to have certifications presented by the CEO and CFO with respect to those internal controls. But it's good to see it's down. It's certainly an area that we probably see more of in the public company arena than we do in the nonprofit arena, but that's not to say that we shouldn't be aware of it in the nonprofit arena also, particularly if you have instances where you may have covenants on debt or financing requirements where there is a motivation maybe to commit a financial statement fraud in order to make your numbers look better or in some case worse, depending on the circumstances of your organization.
Okay, as I was looking through my slides, it looks like we've run the same sort of graph twice here, and what we're looking at here is the occurrence of fraud. Of course, being a CPA, it bothers me that if you take 85 plus 37 plus 9, that's more than 100. What that means is that there are more than one type of fraud. There's a fraud that occurs can have more than one type of fraud involved. So we've got the corruption and asset misappropriation tend to go together, as well as the corruption and financial statement fraud. But 85% of the occurrences relate to asset misappropriation. A lot of the techniques we're going to talk about here cover the prevention of that 85%. The corruption, as Paul mentioned, most often occurs outside of the U.S. as far as a percentage of the total, although it certainly is prevalent in the U.S. And we'll talk about a few techniques related to that. Financial statement fraud, most of the organizations that are being audited, which we'll see later what percentage of companies have financial statement audits, are focused on preventing this type of fraud. I think the ones that we read in the papers about, you can usually point back to some failure of the auditor at some point to fail to pick up some of these major frauds here. They're certainly blamed for, that's for sure.
And this is telling us, Jeff, that certainly misappropriation of assets in many organizations, even though the dollar loss on average is less than financial statement fraud, this is where a lot of the frauds are occurring.
Yeah, this is where they actually occur. And as the listeners on the line here, most of us are focused on limiting at least the asset misappropriation, which can reduce substantially the total dollar losses of an organization. And here we can see, similar to the slide we had a couple slides back, where the average loss this year in this study for financial statement fraud is $1 million. Asset misappropriation is only 130,000, but only 130,000. I'm sure the listeners on the line here would not want their organizations to have that type of loss. That can be crippling to most small organizations, which make up most of the population here on the call.
I think the other thing too to point out with asset misappropriation is, or any type of fraud, I guess, for that matter, but certainly on the asset misappropriation, and particularly for nonprofit organizations, is not only is there a financial loss to the organization, but there is this significant loss to the organization from a public perception perspective. certainly if donors are giving money to an entity and that entity ends up in the papers due to a significant fraud occurring, that can be very, very damaging to the organization. So, certainly we're dealing with dollars that we're losing, but we're also dealing with some other, very relevant risk areas to the organization too.
Okay, so we're going to launch our second polling question. What type of fraud is most costly to a business organization? Is it corruption, financial statement fraud, asset misappropriation, or other?
And we're talking about on a per occurrence basis. I think we have to.
Right.
we have. Let's clarify that one here a bit.
And also, as a reminder, we are going to post a PDF of the slides as well as a recording on our website, and that will be ready within 3 business days. So please take a minute to submit your answer if you have not already done so. All right, and I think we'll go ahead and close the polls in 3, 2, 1. Okay, let's take a look at how the audience responded.
And clearly, on a per occurrence basis, financial statement fraud is the most costly. That was a poorly worded question, though. I will give you that. People can put asset misappropriation. If you took the number of occurrences multiplied by the average dollar loss, you could certainly say that was one of the most costly that there is out there. But we were intending this to be on a per occurrence basis.
So moving on to detection of fraud, and what are some of the more common methods of detection. Before I talk about that a little bit, one of the things that is interesting from looking at the report is that in approximately 50% of cases of fraud, there's no financial recovery. So that in and of itself is a statistic that should make us all very, very cognizant of the need to catch fraud before it occurs. Detecting it, while obviously very important if it is occurring, is problematic insofar that only 50% of the time it's a financial recovery. And the most common way, actually, in which frauds are detected are through tips. And in fact, 42% of all frauds listed in the survey were initially discovered through a tip. I know that when I talked to Jeff and some of the other members in his group that work in the area of fraud investigation, a lot of the investigations over the years initially start with a tip from someone inside the organization. The next most common detection method that we see via the survey is via management's own internal controls, or in the case of larger organizations, an internal audit function. It's quite interesting here because it really tells us that the controls within the organization are critical to the prevention and detection of fraud. We'll talk a little bit later about some red flags and some warning signs, but it's really critical to take away from our presentation today that you have to be familiar with the fraud triangle. You have to be familiar with what you can control in that triangle, which is opportunity, and then you have to implement methods and processes to control the opportunity so that the prevention and detection of fraud is high on your list as a financial executive. One of the things we hear from time to time, and as part of an audit, we are required to plan and perform our audit to detect material misstatement in the financial statements that occurs due to fraud, whether via misappropriation of assets or fraudulent financial reporting. And part of that process for us is we sit down with people in the organization and talk about what do you guys do to prevent and detect fraud. And one of the most scary responses that I hear from time to time is that, well, we have an external audit every year. And the reason that is scary is that, number one, external audits are not designed to detect all fraud. They are certainly designed to detect material misstatement due to fraud, but you may have an immaterial misstatement due to fraud where you have an accounting clerk stealing $4,000 or $5,000 a month from you that might not be material in the overall realm of your financial statements, but certainly is very, very important to your organization. When we look at external audits, the report indicates that only 3% of all frauds listed in the survey were detected via an external audit. And it's quite interesting that in talking to Jeff, I would imagine that that 3% is probably made up more in the area of financial statement fraud than it is misappropriation of assets.
Yeah, in this survey, it likely is. I can tell you from my experience that a substantial number of the frauds I've investigated were found by our audit department and referred over to me. So financial statement audits are effective in finding frauds, but they're still not the most effective method.
Yeah.
There's no surprise involved. Everybody knows the auditors are coming, and if anybody's going to hide anything, they're going to try and hide it from the auditors and have plenty of time to plan that because the auditors are out once a year, as opposed to the employee that sits in the cubicle next door, or the controller watching the accounting manager and enforcing these type of controls is in the organization every single day.
Yeah, absolutely. One of the things that this tells us, certainly when we look at that 42% percentage, is that every organization should have some formal process in place for employees, if they wish, to provide tips through an anonymous hotline or some other similar medium to report fraud. I think one of the things that is very important is that be an anonymous hotline. In many cases, employees are maybe reluctant to report something for fear of retribution or for fear of how that's going to be perceived among their colleagues or others at the organization. Sometimes people just don't want to get involved. They feel that if I report this, then there's going to be an investigation. Maybe I'm have to go to court. So provide an opportunity for them to report it anonymously. 42%, which is close to half of the frauds, are being discovered via tips. So make sure you have some mechanism out there that allows employees to report instances of fraudulent financial reporting or misappropriation of assets.
Before we move to the next slide, I do want to talk about two more instances on detection of fraud. One related to audit and one related to management oversight. I believe it's a year or two ago, I investigated a fraud found by our auditors when they were doing a simple check sequencing test, and they tested, I think it was the largest vendor in a huge organization, 100 million plus in sales. And the largest vendor, they just randomly sampled some of the checks of that vendor, which were paid thousands of checks every single year. And it turned out that the accounting manager had, again, a check stamp that had been forged from the controller and was signing checks, reporting them as being sent to the vendor, but instead it was paying her own credit card bills. So through this random check sampling, the auditors were able to detect this fraud, and we ended up writing a report, filing a police report, and I believe that the accounting manager is currently serving time in jail. So there's an example of where the audit did find a fraud through a random check sampling process that we have and run on most every one of our audits. A second one is management oversight, or lack thereof. It was another homeowners association where the building fund had been managed by the treasurer, accumulated over a number of years. He would generate financial statements every month or every quarter whenever they asked him, but nobody on the board ever looked at the actual bank statements. And so though he reported $100,000 in the bank account, there was really only about $10,000 in the bank account because he had taken all of it. It was finally Finally, somebody did ask a question, and that's what overturned the matter. Again, he was. We wrote a report, submitted to the police, and I believe he fled the country.
And I think it's important to follow that up with just an overall comment. You know, your auditors do perform a lot of procedures in the arena of fraud. As I mentioned earlier, the audit is required to be designed to detect material fraud. So there are a lot of procedures being performed by your auditors. However, the survey does tell us that audit is not a significant factor in the detection of fraud. What I always would suggest, though, is given that your auditors are performing a lot of these techniques, ask your auditors, what are you guys doing in the fraud arena? I know that we do a lot of stuff here at Armanino where we look at payroll patterns, matching vendors against employees in the payroll, looking at reimbursements and the like, that are primarily designed to detect fraud or detect material fraud in the conduct of our audits. So don't be afraid to ask your auditors what they're doing so that maybe you can take some of those techniques and utilize them throughout the year. And the last comment I'll make on detection of fraud, after tips, the next most common detection method is management review slash internal audit. So again, control, process, procedure, and review are critical to the detection of fraud.
So as Paul talked about, tips were the most common method in order to find fraud, detect fraud. One method we didn't mention on there, 11% of all frauds are found by accident. And in fact, I have one that the business owner was trying to pay his accounting manager, controller, bookkeeper a bonus. And he went to figure out he didn't remember what he paid her the year before, so he went to go find the check that he wrote to her the year before in their files, and the check was missing. So he went back to the prior year and checked and couldn't find that check either. He checked the bank statement and realized that I think she had paid herself, she had added a couple $1,000s or a few $1,000s to each one of her bonuses, and that's how he found that she'd been stealing from him for years. But let's get back to tips. Since the survey was first completed in 2002, the most common method, so this goes back over 10 years, consistently, tips are the most common way in which fraud is detected. This year's study, unfortunately, only 54% of all companies had hotlines. That's why I put the graphic up there with the red phone. A hotline is a very inexpensive way to implement a fraud control. Doesn't cost much to maintain, and it can be very well publicized throughout the organization. In fact, we are working with a vendor right now. Hopefully we'll have a hotline service in place in the next few weeks here at Armanino that we can offer to our clients. Everybody who's on the line today will probably get an email from me in a bit when we have this in place to see if you're interested in such a service. The key thing about this is the tips can be either made by name or anonymously. The tips come into a call center, which is forwarded to our firm or whoever the vendor is, and then that independent entity then contacts the appropriate members at the company, whether it's that's the top of the organization, so it would be the president or executive director, an internal board member possibly, or the chief accounting officer, depending on who the fraud is implicated against. Obviously, if the tip comes in that the CFO is stealing money, that the response isn't going to go to the CFO. It would go to either the president or external board member. But the tips can come in, and the service we're looking at via email or via phone call. Some statistics I wanted to talk about. Organizations with hotlines had 51% of their frauds discovered through tips, while organizations without hotlines had only 35% of their frauds discovered through tips. The last thing I want to point out on here, only 18% of all organizations with less than 100 employees, which may be the majority of this call, only 18% had a hotline. 80% of companies have, in the survey had financial statement audits, but as we saw, that was not the most effective method to detect fraud, where this is. A hotline costs a lot less than a financial statement audit, and can provide a lot more control, and it's a very well publicized control that is in place. And by being anonymous or reporting a name, it gives the employees the options and makes them more comfortable about reporting such a fraud. Okay.
So who are the targeted organizations reported in the study? Well, unsurprisingly and consistent with previous studies, privately held companies continue to incur more fraud losses than publicly traded companies. And this is understandable in that typically in privately held companies, there is potentially more lack of internal control, internal audit, and formalized control testing, such as required by Sarbanes-Oxley for public companies than in privately held companies. A total of 30% of all frauds in the current study, in fact, were in privately held companies. And 29% of all of the frauds occurred in organizations with less than 100 employees. So that's very, very important to think about, because a lot of the nonprofit organizations that we work with have less than 100 employees, and in some instances, significantly fewer employees. What that results in is difficulties with segregation of duties in the performance of internal controls, which in turn leads to instances where one individual is performing a number of incompatible duties for the organization. Now, while we would all like to be able to go and hire 5 or 6 or 7 people to perform incompatible duties, we all know that that's not practical in many cases in small organizations. So what we need to be focusing on there is what we call mitigating controls in order to reduce the fraud risk in those organizations. And we'll talk a little bit later about some of the areas where we can implement what are sometimes pretty simple techniques to mitigate some of that risk. In the study, 11% of the investigated frauds were in nonprofit organizations, and the median loss there was $108,000. While it's only 11%, nevertheless, that's 1 in 10. And a loss of $108,000 at a median level is by no means something that any of us would look at as a normal cost of doing business. So certainly the risk is out there. It's particularly prevalent in smaller organizations. It's more prevalent in private or nonprofits than it is in publicly traded companies. Therefore, we need to be particularly more vigilant in our area than in preventing and detecting fraud and putting the types of processes in place to do that. Segregation of duties, management oversight, processes and procedures, cross-training of employees, making sure people take vacations, monitoring the red flags, employees who keep everything tight to the chest, who never want to go on vacation, who are always behind. Those are all red flags you should be aware of. And typically, if you have an accounting function that at any level that is a mess, that's a red flag. We'll talk a little bit more about red flags as we move on, but in the interest of time, let's get on to our next polling question.
All right, so we're at polling question number 3. And this is a true or false question. And it reads, most frauds are discovered through financial statement audits. Is that statement true or false?
And we're asking a bunch of questions here, but we only have one question being asked of us right now. So please, if you have any questions you're thinking about, please send them on over to us. And Paul and I are going to try and limit our stories now to make sure we can cover all of the rest of the materials we have, because we're coming up on specific techniques as well as some checklists to red flags, techniques, and a checklist. So that's 90% voted here.
Yep.
So.
Okay, so we're going to go ahead and close the poll. And let's see how everyone responded.
Almost at 100% this time. Oh. Somebody said true. Yeah, no, the answer is false. That, as we talked about, 3% of frauds reported on this survey came from financial statement audits, and that's pretty consistent with the previous surveys we've seen. So please don't think because we have a financial statement audit, we don't have to worry about any of this stuff, because very few frauds are actually detected through that. Some are, and as I said, in my career, the large majority of the frauds I've investigated have come from our audit department by auditors finding things. So they're always there, but those are usually larger organizations. So the small organizations, which makes up the population of this call, usually have more lax controls, and simple things can be put in place, which we'll talk about in just a minute.
So what is the profile of the average fraud perpetrator? Well, the report indicates that 82% of all fraudsters were first-time offenders. So, of course, those types of individuals would most not likely be uncovered via a background check, or maybe a risk factor might not occur via background check. And although employees perpetrated the most frauds in the survey at 40% of occurrences, they had the lowest median losses at less than $100,000 a year, or excuse me, per event. Executive losses, which are the C-level individuals at the organization, those losses were significantly higher and averaged $500,000 in the 2014 study, although that is down from $834,000 in the 2008 study, which is impressive. The average perpetrator is still a male in the 36 to 45 age range.
Excludes us now.
Yes, excludes us, which is a good thing. And most losses occurred when an employee had been on the job 1 to 5 years, which typically tells us that they've been there enough time to gain the confidence of their managers and supervisors. As the old saying goes, and I think as Jeff mentioned, those you don't trust typically find it more difficult to steal from you. Median losses for employees with 1 to 5 years, once again, were a fraction of those employees with 10 plus years of experience. And this is telling us that people with larger tenures with the organization who commit fraud, the losses are going to be much, much larger. I think it's very important to remember or to recognize, I think, that for the number of times that Jeff and I have been told when a fraud occurs that I cannot believe that person would have done that. They've been with us 15 years. They do everything. They're a wonderful employee. I just can't believe it. So keep that in mind. Not surprisingly, accounting departments had the highest losses and the occurrences. And generally, this is, again, due to a lack of segregation of duties and a lack of oversight of those employees. So again, you've got to have the right processes, controls in place, and then you've got to have oversight of those controls. And this, again, goes back to what we talked about earlier, opportunity. If there are no controls and there is no oversight, there is opportunity. If there is opportunity and then there is also rationalization, then fraud is something that very, very may well occur. Moving on. Some of the things that we need to look at from the perspective also of the average perpetrator. Majority of the fraud is incurred in accounting, sales, upper management, customer service, and purchasing. Purchasing is a big area, and even if you're a small organization that does not have a purchasing department, a lot of the frauds we see are in fictitious vendors or fictitious cash disbursements. So make sure you're keeping an eye on that. What are some of the behaviors we see in the average perpetrator? Well, certainly, if you have an employee who never takes a vacation, that is a red flag. Now, none of these red flags necessarily mean that an individual is actually perpetrating fraud, but these are red flags. Employees who appear to be living beyond their means. Again, red flags. These are instances where you have to look at that particular employee and ask yourself, is the lifestyle of that employee consistent with your knowledge of that employee? If you have an employee that, to your knowledge, is experiencing financial difficulty, do you have employees that have particularly close associations with vendors or customers? I talked earlier about employees that want to keep everything to themselves, excessive control issues about other people performing parts of their work duties. One of the key areas that we find, I would say, in a significant number of our frauds is that the accounting records are significantly behind or they're a mess. So if you have a situation, for example, where bank reconciliations at an organization are several months behind, you've got to ask yourself, why is that individual several months behind? Is that because that individual is potentially trying to conceal a fraud? We talked earlier about fictitious vendors. Big risk area, an area that we see a lot of problems in. Make sure that you're looking at your vendor listings periodically. Make sure that you understand your processes for setting up vendors in the system and that there are appropriate controls over those processes.
All right, thank you, Paul. So we are now at our last polling question. And we'd like to hear from you. Does your company have a fraud hotline? So both Paul and Jeff talked about this. Does your company have a fraud hotline? You can let us know, yes or no.
I believe the quote, the percentages that they talked about in the survey, 18% of organizations under 100 employees had hotlines. In the entire survey, 54% of all companies had hotlines. And we are running right between that right now. So, as I said, this is a very cost-effective, very public way to increase the awareness of fraud within your organization and give an outlet for reporting fraud.
All right. So it looks like the majority of our audience has responded. So let's take a look and see what they said.
So we're right in the middle. 18% of organizations under 100 had reporting capabilities. There were 30% here, and then 54% overall in the survey had hotlines. So this is not surprising, but it also means that there's quite a few people that do not have hotlines that could increase their fraud awareness by simply implementing one. As I said, we'll be in touch shortly as soon as we can get this type of offering out to our client base.
So we've got about 8 to 10 minutes or so left, so we're going to go through some prevention techniques. And many of these we've spoken of already during the webinar so far. Anonymous outside fraud hotline. As Jeff mentioned, most of the frauds are being reported that way. Definitely something to consider. Segregation of duties. Looking at incompatible duties in your finance function, in your organization, and making sure that they're adequately segregated to reduce your fraud risk. In those instances where you just don't have the people to adequately segregate them, talk to your auditors about what we call mitigating controls. Many instances, if you don't have the personnel, you can still put mitigating controls in place. One of those mitigating controls, of course, is job rotation. If you're moving somebody in and out periodically in a particular function, and there is something going on the fraudulent spectrum in that function, job rotation typically tends to be a good way of bringing that to the attention of management. And then management review, critical component, making sure that management is overseeing the functions and reviewing the work that people are doing. People are behind on bank reconciliations, there's a problem. Somebody is setting up people in the payroll system without adequate oversight, that's a problem. Somebody is setting up vendors without oversight, that's a problem. So management review, key component of preventing and detecting fraud. Very important, set the proper tone at the top. Critical that the perception of the employees in the organization is that Fraud will not be tolerated. There are controls in place at the organization to prevent and detect fraud. The organization has processes and procedures in place to address fraud risk areas such as segregation of duties, inadequate independent checks, individuals not taking vacations. Surprise audits, very, very good technique, particularly in those areas where you're processing a lot of cash. I have clients that, large nonprofits that process lots of cash at certain locations. They will have surprise audits throughout the year where somebody will come on site, pull the cash, and test it in a surprise basis. What this does is, in addition to being a good detection technique, it's also a good prevention technique in that employees are on alert that at any particular point in time you may be arriving for a surprise audit. As Jeff mentioned, do not rely on external audits. External audits, while we do design them to prevent and detect material fraud, and have detected a number of frauds here over the years as a result of our audits, it should not be your primary methodology for detecting and preventing fraud. And then fraud awareness training. Critical that you have a fraud awareness training process in place so that your people know what the red flags are and how to respond to those.
So we're starting to run out of time, and Paul and I may have gone through these last two topics relatively quickly. Our emails will be up in a couple minutes here. If you have any other questions, please feel free to email us directly, and we'll be happy to respond to anything. So now we're going to talk about, is your organization doing these things? Is anti-fraud training provided to everybody? All employees, top to bottom. As I said, as we implement a hotline service, we'll provide training like this. Not a tremendous amount of time, very simple, especially running through a webinar, can be handled remotely and at people's computer desks. Is there a reporting process in place? We can't say hotlines enough here. Are proactive measures being taken and publicized? So, as I said, publicizing where people can report frauds should be known to everyone. What's the management climate? Paul talked about the tone at the top. I always have said that the fish rots from the head down. If the top of the organization is not emphasizing how strict people should be on controlling fraud, then there is going to be fraud within the organization. Do people make fraud assessments? So a fraud assessment is maybe in connection with a financial statement audit, but also maybe if an audit's not done, simply having somebody from the external come in and determine if there are controls there are at least controls in place. We don't test the controls, but we just see if there are controls in place and watch out for red flags that could exist. And I think finally, if there is an internal audit department, do they have enough resources? If you have one internal auditor for 1,000 employees, probably not good enough. You can't rely on that one person to police, thousands of people in multiple locations. Are background checks being done in the hiring policy? Although we did say that only 80% of people are first-time offenders, you don't want to be like the homeowners association and employ somebody who committed a fraud at their last company. Is there an open door policy in place that allows employees to come in and out and talk about concerns that they have? And are anonymous surveys taken? Are you asking your employees if they're aware of anything and creating that culture of fraud reporting? Let's go to the last slide and leave our emails up. We're going to so we've covered a bunch of things here we talked about, I believe. We've got a couple of questions we're going to answer here. Actually, we have a few questions, but we're going to get to as many as we can because we are at 11 o'clock. Michelle, you want to read a couple of these?
Sure. So the first one that we have says, we have employee tips that have not been followed up on in a fair or effective way to eliminate stealing goods, etc. Do we have a sense how much less fraud is reported when small known issues are not resolved?
I can take that. One of the things we've talked about today is tone at the top, and I think it's very, very critical to an organization that the tone at the top is one of taking fraud seriously. no matter what the magnitude of the fraud is. And Jeff can comment on this too, but I think if you have a situation where minor fraud or fraud is being reported, but those instances are not being followed up on as the question notes, a fair or effective manner, I think that sends a worrying message to individuals that, okay, maybe it's okay to do this. So I think that would probably result in less fraud being reported, in that an individual is going to say, well, gosh, if issues aren't being followed up, why report it? What do you think, Jeff?
Yeah, no, I agree. And it sets a bad tone at the top. And then in every organization I've been around, when some procedure, some control isn't in place, and some fraud, no matter, it may be, if it's extremely minor, maybe people will let it get away with it. But if it's not minor, or it could be substantial, or could be prevalent throughout the organization, a control has to be put in place. It doesn't have to be, don't have to call the police in place, but a control can be put in place to limit that type of behavior in the future. We have one more question we have time for?
Yeah, probably time for one more.
All right.
Okay, so we have another question, and I know everyone is typing them in, so for the sake of time, I think we'll do one more, and then if you have any other following questions, we can have Jeff or Paul follow up with you. So the second question is asking about insurance coverage bonds for fraud. Is it expensive? Is it effective? What's your opinion?
One of the investigations I did this year had to do with, they had errors and omissions insurance of the company. I don't believe it was overly expensive, but the report I did was to ensure that the claim was paid, and the company was reimbursed for substantially the loss that I quantified the loss and made a report on it, and then the company was paid back for that cost, which is far in excess of what the fees were involved to determine that loss. So I believe that the fraud law should be in place to protect the company against fraudulent employees. You generally don't want to have to collect on these things, and the prevention techniques are more effective. But when that does occur, most of my reports that are actually issued and related to fraud either go to law enforcement or to insurance companies to show what the extent of the fraud is and how to be compensated for it. Any questions we didn't get to, either Paul or I will make sure we respond in the next day or so. If we didn't answer your question, we'll respond via email, because we'll have your information and get back to you.
Yeah, we have a lot of questions here, and fraud is an area that, it's an interesting area, and it's certainly one that we could probably talk for 8 hours on. So feel free, as I mentioned earlier, one of the good ways to evaluate your fraud risk processes in your organization is talk to your CPA or talk to your auditor. So feel free to reach out to Jeff or I with any follow-up questions that you may have about what you're doing internally and how best that you can structure your organization to prevent and detect fraud. Thank you so much for sitting in on the webinar.
Thank you.
Thanks to Jeff. As an auditor, I always have a lot of fun sitting and listening to Jeff's stories. While scary, they're always very interesting and enlightening. So I do appreciate him joining us today.
Thank you very much for your time, and please take a second as you exit the webinar to complete our survey at the end. Thank you very much, and enjoy the rest of your day.